Understanding the types of income statement. An income statement, often referred to as a profit and loss statement, is a fundamental financial report that provides a summary of a company's revenues, costs, and expenses over a specific period, such as a quarter or a year. This statement is crucial because it reveals whether a company is generating a profit or incurring a loss during that period. There are several types of income statements, each serving different purposes and providing varying levels of detail. The main types are the single-step income statement, the multi-step income statement, and the comprehensive income statement. Single-step income statement. The single-step income statement is the most straightforward type. It combines all revenues and gains into one section and all expenses and losses into another. The net income is calculated by subtracting the total expenses from the total revenues. This approach is simple and easy to understand, making it particularly useful for small businesses or companies with uncomplicated financial structures. In a single-step income statement, there is no distinction made between operating and non-operating items. All sources of revenue are grouped together, whether they come from the company's primary business activities or other sources, like interest income. Similarly, all expenses, including operating costs like rent and utilities as well as non-operating costs like interest expenses, are lumped together. The result is a single figure representing the company's net income. While this simplicity is advantageous in some cases, it can also be a limitation because it does not provide insight into the different areas of the business. For example, stakeholders cannot easily see how much of the income is generated from core operations versus other activities. Multi-step income statement. The multi-step income statement is more detailed and informative than the single-step version. It breaks down the financial information into multiple sections, which provides a clearer picture of the company's operational performance. The statement is divided into three main parts: gross profit, operating income, and non-operating income. The first section of a multi-step income statement calculates the gross profit, which is determined by subtracting the cost of goods sold from sales revenue. Gross profit reflects the efficiency of the company's production or service delivery processes. It shows how much money is left after covering the direct costs associated with producing the goods or services the company sells. Next, operating expenses are subtracted from the gross profit to arrive at the operating income. Operating expenses typically include selling expenses, administrative expenses, and depreciation. Operating income represents the profit generated from the company's core business activities, excluding any income or expenses that are not directly related to these activities. This figure is a key indicator of the company's operational efficiency and profitability. Finally, the multi-step income statement accounts for non-operating items. These might include interest income or expenses, gains or losses from investments, and taxes. After considering these factors, the net income is calculated, representing the company's overall profitability. The multi-step format is particularly useful for stakeholders who need to understand the different components of a company's financial performance, such as investors, analysts, and management. By breaking down the income statement into these sections, stakeholders can better assess the company's core business operations and make more informed decisions. Comprehensive income statement. A comprehensive income statement is an extended version of the traditional income statement. In addition to the net income, it includes other comprehensive income, which consists of revenues, expenses, gains, and losses that are not included in net income. These items might be excluded from net income because they are not realized or because accounting standards require them to be reported separately. Examples include unrealized gains or losses on certain investments, foreign currency translation adjustments, and pension plan adjustments. The comprehensive income statement provides a more complete view of a company's financial performance by capturing all changes in equity that are not the result of transactions with owners. This type of statement is particularly important for larger corporations or companies with complex financial structures where significant items are excluded from net income. While the comprehensive income statement is less commonly used than the single-step or multi-step statements, it is a valuable tool for providing stakeholders with a fuller understanding of the company's financial health. Key takeaways. The income statement is a crucial financial document that provides insights into a company's profitability. The single-step income statement is simple and easy to understand, making it ideal for small businesses with straightforward operations. However, it lacks the detail needed to fully assess the different components of a company's financial performance. The multi-step income statement offers more detail by separating operating and non-operating activities, making it more suitable for larger businesses or those with complex operations. Finally, the comprehensive income statement provides an even more complete picture by including items that are excluded from net income, offering a fuller view of a company's financial performance. Each type of income statement serves different purposes, and the choice between them depends on the needs of the business and its stakeholders.